The window is closing faster than most people realize. While the mainstream financial media keeps telling you everything is fine, there's a quiet panic happening behind closed doors at some of the world's largest financial institutions. And if you're not paying attention right now, you're going to miss the opportunity of a lifetime while simultaneously exposing yourself to a risk that could devastate your retirement savings. Let me show you what's really happening in the precious metals market right now, because what I'm about to reveal isn't being discussed on CNBC or Bloomberg. This is the kind of information that gets shared in private meetings between central bankers and institutional investors. The kind of intelligence that moves billions of dollars before the general public even knows what's happening. Gold has been on an absolute tear, breaking through resistance levels that analysts said were impossible just months ago. Silver is following right behind, and the ratio between the two metals is telling us something critical about what's coming next. But here's what nobody's talking about. The premiums on physical metal are starting to disconnect from the paper prices in a way we haven't seen since the chaos of the early pandemic days. And that disconnect is a warning signal that should have every investor paying very close attention. Think about what a premium really means. It's the extra amount you pay above the spot price to actually get your hands on physical metal. When premiums are low, it means there's plenty of supply and dealers are competing for your business. But when premiums start climbing, it means something very different. It means the people who actually have the metal in their vaults are getting nervous about letting it go. It means demand is outstripping supply. And it means that the paper price you see quoted on financial websites might not reflect what you'll actually pay when you try to convert dollars into ounces. Right now, we're watching premiums climb across the board. Silver eagles that used to carry a modest premium are now commanding prices significantly above spot. Gold bars from reputable refiners are getting harder to source, and when you do find them, you're paying more than you would have just weeks ago. The dealers I talk to are telling me their suppliers are getting selective about who they sell to, prioritizing their long-term relationships over one-time buyers. That's not normal market behavior. That's the behavior of a market that's starting to seize up. Before we go any further, I want to make sure you have access to the information that could protect your wealth in what's coming. I've put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. Grab it now while it's still available, because the strategies inside are exactly what you need to understand before premiums climb even higher. Now, let's talk about why this is happening and why the timeline matters so much. The precious metals market operates on two levels that most people don't understand. There's the paper market, where contracts representing gold and silver trade electronically on exchanges like the COMEX. And then there's the physical market, where actual metal changes hands and gets delivered to vaults. Under normal circumstances, these two markets stay relatively aligned. The paper price influences the physical price, and arbitrage opportunities keep them from drifting too far apart. But we're not in normal circumstances anymore. The paper market has become so leveraged, so disconnected from physical reality, that it's starting to break down. Every ounce of physical gold has dozens of paper claims against it. It's like a game of musical chairs where there are 100 people dancing around 10 chairs and everyone's pretending that's perfectly fine until the music stops. Well, the music is starting to slow down, and some very smart players are making sure they have a chair before the rush begins. Central banks understand this better than anyone. They've been net buyers of gold for years now, but the pace has accelerated dramatically. They're not buying paper contracts. They're demanding physical delivery and repatriating their gold from foreign vaults. When a central bank in Asia or the Middle East decides it wants its gold back from London or New York, that's metal leaving the system. That's supply that's no longer available to satisfy other claims. And every ounce that gets locked away in a sovereign vault is one less ounce available to meet the growing demand from investors who are finally waking up to what's happening. The industrial demand story for silver makes this even more critical. Silver isn't just a monetary metal anymore. It's absolutely essential for the green energy transition that governments around the world have committed to. Every solar panel requires silver. Every electric vehicle requires significantly more silver than a traditional car. The electronics industry depends on silver's unique properties. And here's the problem. We're not mining enough silver to meet current demand, let alone the projected demand from all these new technologies. The silver market has been running a deficit for years. That means we're consuming more silver annually than we're pulling out of the ground. The gap has been filled by above-ground stockpiles, recycled silver, and investor selling. But those sources are finite. The stockpiles are dwindling. Recycling can only provide so much. And investors who sold silver when it was cheaper are now watching the price climb and regretting their decision. At some point, and I believe we're approaching that point rapidly, the market is going to have to reconcile the fact that there simply isn't enough physical silver to satisfy all the competing demands. When that recognition hits the broader market, premiums aren't going to climb gradually. They're going to explode. We saw a preview of this during the pandemic when premiums on silver coins went from a few dollars over spot to $10, $15, even $20 over spot. Dealers were sold out for months. Mints couldn't keep up with demand. And that was just a taste of what happens when a relatively small number of retail investors decide they want physical metal all at the same time. Now imagine what happens when institutional investors, family offices, and sovereign wealth funds decide they need physical exposure. Imagine what happens when pension funds and endowments realize that their paper claims might not be worth what they think. Imagine what happens when the general public, the millions of people who have never thought about precious metals, suddenly decide they need to protect their wealth from currency debasement and financial system instability. The infrastructure to deliver physical metal to that level of demand simply doesn't exist. The mints can't scale production fast enough. The refiners can't process material quickly enough. The logistics of moving, storing, and securing that much metal would be overwhelming, and so premiums would have to rise to ration the available supply. They would rise to the point where only the most motivated buyers would be willing to pay, and if you're not already positioned before that happens, you're going to be one of the people on the outside looking in, watching the price climb beyond your reach. Let's talk about what's driving this urgency right now, because the timing isn't random. The global financial system is under more stress than most people realize. Government debt levels are at historic highs and climbing. Central banks are trapped between the need to fight inflation and the need to keep borrowing costs manageable for heavily indebted governments. The banking system is still fragile despite all the assurances from regulators. And geopolitical tensions are creating uncertainty that makes investors nervous about keeping all their wealth in financial assets that depend on the stability of the current system. Every one of these factors creates demand for precious metals. Gold and silver have been money for thousands of years because they have properties that make them ideal stores of value. They're scarce, durable, divisible, and universally recognized. They can't be printed by central banks or devalued by government decree. They don't depend on anyone's promise or anyone's solvency. They're real assets that you can hold in your hand. And in times of uncertainty, that tangibility becomes incredibly valuable. The smart money has been positioning for this for years. The ultra-wealthy have been quietly accumulating physical metal and storing it in private vaults. They're not buying paper ETFs or futures contracts. They're buying bars and coins and taking delivery. They're paying for secure storage in jurisdictions they trust. They're treating precious metals as insurance against the kind of systemic risks that could wipe out conventional portfolios. And they're doing it quietly, without fanfare, because they don't want to drive up prices before they've finished accumulating. But that quiet accumulation phase is ending. The signs are everywhere if you know where to look. The premiums are rising. The delivery times are extending. The dealers are getting selective. The mints are struggling to keep up. And the gap between paper prices and physical prices is widening. These are all symptoms of a market that's transitioning from the accumulation phase to the recognition phase, where the broader market starts to understand what's happening and rushes to get positioned. Here's something most people don't understand about precious metals markets. They're tiny compared to other financial markets. The entire gold market is a fraction of the size of the stock market or the bond market. The silver market is even smaller. That means it doesn't take a huge amount of capital flowing into these markets to move prices significantly. When institutional money starts rotating into precious metals, even a small percentage of the trillions sitting in stocks and bonds can overwhelm the available supply and send prices soaring. We've seen this movie before. In the late 70s, gold went from $35 an ounce to over $800 in less than a decade. Silver went from less than $2 to $50. Those weren't gradual moves. They were explosive rallies driven by a loss of confidence in fiat currencies and a rush to hard assets. And here's the thing. The fundamentals today are far more extreme than they were in the 70s. Government debt is higher. Money printing is more aggressive. Geopolitical tensions are more severe. And the derivatives and leverage in the financial system create risks that didn't exist back then. If we see even a fraction of the kind of move we saw in the late 70s, adjusted for today's monetary base and debt levels, we're talking about prices that would seem absurd to most people right now. But they wouldn't be absurd in the context of a currency crisis or a loss of confidence in the financial system. They would be the market's way of repricing real assets relative to devalued paper currencies. And the people who positioned early, who bought physical metal when premiums were still reasonable, would be the ones who preserved and grew their wealth while everyone else watched their purchasing power evaporate. Now, if you're sitting on retirement accounts, if you have $100,000 or more in IRAs or 401ks, you need to understand something critical. You can get physical gold into those accounts without triggering taxes or penalties. Most people don't know this is possible. They think precious metals are something you buy outside of retirement accounts, something that doesn't get the tax advantages. But that's not true. Gold IRAs are a legitimate, IRS-approved way to hold physical precious metals in your retirement account. I've put together a comprehensive guide on how this works. It's in the description. It covers everything you need to know about getting physical gold into your retirement account, how to avoid the common mistakes, and how to work with reputable custodians who specialize in this. If you're concerned about market collapse, geopolitical instability, currency debasement, or any of the other risks we're facing, this is information you need to have. Check out that guide and see if a gold IRA makes sense for your situation. Let me get back to why the premium situation is so critical right now. When you buy precious metals, you're essentially making two decisions. You're deciding to own the metal, and you're deciding when to buy it. Most people focus on the first decision and ignore the second. They think about whether gold and silver are good investments, whether they should have some exposure, whether the fundamentals support higher prices. And those are important questions. But the timing question is just as important, especially when we're in a market environment where premiums are rising and supply is getting tight. Think about it this way. If you wait until everyone else recognizes what's happening, you're going to pay significantly more for the same metal. The spot price might be higher, sure, but the premium on top of that spot price could be double or triple what it is today. You might end up paying 20 or 30% more for the same ounce of silver just because you waited a few months. And that's assuming you can even find metal to buy. During the last shortage, many dealers simply stopped taking orders because they couldn't source inventory. They had customers' money, but they couldn't deliver metal. That's a situation you want to avoid. The premium you pay today is essentially the cost of certainty. You're paying a little extra to ensure you can actually get the metal, to ensure you're not competing with a flood of other buyers, to ensure you're positioned before the recognition phase kicks in. And when you look at it that way, when you understand that premiums are likely to be significantly higher in the near future, paying today's premium starts to look like a bargain. Let's talk about the mechanics of what happens when a shortage develops, because this is where things get really interesting. In a normal market, when demand exceeds supply, prices rise until demand falls, or supply increases. That's basic economics. But the precious metals market doesn't work quite like that because of the paper market overlay. The spot price is determined by trading in paper contracts, not by physical supply and demand. So you can have a situation where the paper price isn't rising much, but physical metal is getting scarce and premiums are exploding. This creates an arbitrage opportunity in theory. If premiums are high enough, it should be profitable to buy paper contracts, take delivery, and sell the physical metal at the premium price. But here's the problem. Taking delivery from the COMEX is complicated, expensive, and time-consuming. You need to be an approved participant. You need to arrange for secure transport and storage. You need to deal with the logistics of moving large quantities of metal. And most importantly, the people who are short those contracts really don't want to deliver physical metal. They'll do everything they can to settle in cash or roll the contracts forward. So, the arbitrage mechanism that should keep paper and physical prices aligned doesn't work as smoothly as it should. And that means premiums can stay elevated for extended periods, especially during times of high demand. We saw this during the pandemic. We saw it during previous periods of market stress. And we're starting to see it again now. The difference this time is that the underlying fundamentals are more extreme, the supply situation is tighter, and the potential demand from institutional investors and sovereign entities is much larger. There's another factor that's going to accelerate this premium expansion, and it's something most people aren't thinking about: the regulatory environment. Governments around the world are getting increasingly aggressive about capital controls, about monitoring financial transactions, about restricting the movement of wealth. They're doing this because they're desperate for tax revenue, because they're worried about capital flight, because they want to maintain control over their monetary systems. And precious metals represent a threat to that control, because they're a way to store wealth outside the banking system, outside the reach of negative interest rates and bail-ins and currency devaluations. We're already seeing increased reporting requirements for precious metals transactions. We're seeing proposals to restrict cash purchases. We're seeing efforts to track and tax precious metals holdings more aggressively. And while these measures are being sold as anti-money laundering or tax compliance initiatives, the effect is to make it harder and more expensive to buy and hold physical metal. That's going to drive up premiums because it adds friction to the market. It's going to reduce supply because some dealers will exit the business rather than deal with the compliance burden. And it's going to increase demand from people who want to get positioned before the restrictions get even tighter. This is why the timing matters so much. Every month that passes, every new regulation that gets proposed, every sign of financial system stress makes it more urgent to get positioned. The people who wait, who think they have plenty of time, who assume they can always buy metal when they really need it, are going to be the ones who end up paying the highest premiums or unable to find metal at any price. Let me tell you about what happened in India a few years ago, because it's a perfect example of how quickly things can change. The Indian government, worried about the country's trade deficit and the amount of gold being imported, imposed strict restrictions on gold imports and raised import duties dramatically. Almost overnight, the premium on gold in India exploded. People who wanted to buy gold were paying 20, 30, even 40% above the international spot price. A massive smuggling operation developed to meet the demand, and people who had accumulated gold before the restrictions were sitting on enormous gains, not because the spot price had risen, but because the premium had gone through the roof. That's an extreme example, but it illustrates the principle. When governments restrict access to precious metals, premiums rise. When supply gets tight, premiums rise. When demand surges, premiums rise. And we're seeing all three of these factors starting to align right now. The smart move is to position before the alignment becomes obvious to everyone else. Now, let's talk about silver specifically, because silver has some unique characteristics that make the premium situation even more critical. Silver is much bulkier than gold. An ounce of gold is about the size of a large coin. An ounce of silver is much larger. That means storage costs more, transportation costs more, security costs more, and all of those costs get reflected in premiums. When demand for physical silver surges, the logistics of moving and storing all that metal become a real constraint. Dealers have to pay more for vault space. They have to pay more for armored transport. They have to tie up more capital in inventory, and all of that gets passed on to buyers in the form of higher premiums. Silver also has a much smaller investor market than gold. Most silver production goes to industrial uses. Only a fraction goes to investment demand. That means the amount of silver available for investors is limited, and when investment demand picks up, it can quickly overwhelm the available supply. We saw this during the Reddit-driven silver squeeze attempt. Even though that was mostly retail investors buying relatively small quantities, it was enough to create shortages and drive premiums to extreme levels. Imagine what happens when institutional money starts flowing into physical silver. The silver-to-gold ratio is another factor that's telling us something important. Historically, this ratio has averaged somewhere in the range of 50 to 60 ounces of silver to 1 ounce of gold. Right now, we're seeing the ratio compress as silver starts to outperform gold. That's typical of the later stages of a precious metals bull market. Silver is more volatile than gold, and it tends to lag in the early stages of a rally and then catch up explosively in the later stages. The fact that silver is starting to show relative strength suggests we're entering that phase where the real gains happen. But here's the catch. If you wait until silver is obviously outperforming, until everyone is talking about it, until the mainstream media is covering the silver rally, you're going to be buying at much higher premiums. The time to position in silver is before that recognition phase, when premiums are still reasonable and supply is still available. And that window is closing fast. Let me share something that a major dealer told me recently. He said that his suppliers are starting to allocate inventory rather than selling to whoever wants to buy. They're prioritizing their long-term customers, the ones who've been buying consistently for years. They're limiting how much any single buyer can purchase. They're extending delivery times. These are all signs of a market that's getting tight. And this is happening before we've seen any real panic buying, before the general public is even aware that there might be a supply issue. What happens when awareness spreads? What happens when people start reading articles about precious metal shortages? What happens when they see premiums climbing and realize they need to act? You get a rush to the exits, except in this case it's a rush to the entrance, everyone trying to buy at the same time. Dealers overwhelmed with orders, mints running at full capacity but still unable to keep up, and premiums going vertical as the available supply gets rationed to the highest bidders. This isn't speculation. This is pattern recognition based on what's happened multiple times in the past. The precious metals market goes through cycles of complacency and panic. During the complacent phases, premiums are low, supply is abundant, and nobody's worried about being able to buy metal. During the panic phases, premiums explode, supply disappears, and people are desperate to get whatever they can at any price. We're transitioning from complacency to panic right now. The early signs are all there, and the people who recognize this and act accordingly are going to be positioned perfectly for what's coming. There's also a psychological element to this that's worth understanding. When premiums are low and metal is readily available, it's easy to procrastinate. You think you can always buy later. You think there's no rush. You think you'll wait for a pullback or a better entry point. But when premiums start rising and supply starts getting tight, that psychology flips. Suddenly you're worried about missing out. You're worried about paying even higher premiums if you wait. You're worried about not being able to find metal at all. And that fear drives buying behavior that becomes self-reinforcing. The more people rush to buy, the tighter supply gets, the higher premiums go, and the more urgent everyone else feels about getting positioned. This is why the title of this video emphasizes that time is running out. It's not hyperbole. It's not clickbait. It's a recognition of where we are in the cycle and what's likely to happen next. The window for buying at reasonable premiums is closing. The window for ensuring you can actually get physical metal is closing. And the window for positioning before the broader market recognizes what's happening is closing. Let me give you some specific things to watch for that will tell you we're moving into the panic phase. First, watch delivery times. If dealers start quoting delivery times of weeks or months instead of days, that's a red flag. Second, watch product availability. If popular products like Silver Eagles or Gold Buffaloes are consistently out of stock, that's a red flag. Third, watch premiums on different products. If premiums start diverging significantly, with some products commanding much higher premiums than others, that's a sign that supply is getting allocated and people are paying up for whatever they can get. Fourth, watch the spread between bid and ask prices. If dealers are widening their spreads, that's a sign they're uncertain about their ability to replace inventory and they're building in more cushion. All of these indicators are starting to flash warning signs right now. They're not at panic levels yet, but they're moving in that direction. And the smart money isn't waiting for panic levels. They're acting now while they still can, while premiums are still reasonable, while supply is still available. They understand that by the time it's obvious to everyone that there's a problem, it's too late to position at attractive prices. Here's what you need to understand about the endgame for this situation. At some point, the paper market and the physical market are going to have a reckoning. The fiction that every paper claim can be satisfied with physical delivery is going to be exposed. When that happens, one of two things will occur. Either the paper price will have to rise dramatically to reflect the scarcity of physical metal, or the paper market will break down entirely, and physical metal will trade at a significant premium to paper prices. Either way, the people who own physical metal will be in a much better position than the people who own paper claims. This is why central banks demand physical delivery. This is why sophisticated investors pay for secure storage. This is why the ultra-wealthy are willing to pay premiums to ensure they have real metal, not just a promise of metal. They understand that in a crisis, paper promises become worthless. Only physical possession matters. And they're willing to pay for that certainty now, rather than hoping they can get it later when everyone else wants it too. The opportunity in front of you right now is to position yourself like the smart money, to act before the crowd, to secure physical metal while premiums are still reasonable and supply is still available. This isn't about trying to time the perfect bottom or waiting for the ideal entry point. This is about recognizing that we're in a transition phase, and that the cost of waiting is likely to be much higher than the cost of acting now. Think about your retirement savings. Think about the wealth you've accumulated over years or decades of work. Think about what happens to that wealth if we see significant currency debasement, if we see financial system instability, if we see the kind of crisis that makes people question the value of paper assets. Precious metals have been the ultimate insurance policy against those scenarios for thousands of years. They've preserved wealth through wars, through currency collapses, through the rise and fall of empires, and they're going to preserve wealth through whatever challenges we face in the coming years. But insurance only works if you have it before you need it. You can't buy fire insurance after your house is burning. You can't buy flood insurance after the waters are rising.